Welcome everyone to the Kendall Report. It is Tuesday night. What a day we had today, huh? I think this is going to be another popcorn night, so you might want to get the popcorn out and get ready. I had a couple things occur today that just really triggered me into some interesting thoughts. So I'm all bundled up because we're getting snow tonight again. I know it's supposed to be spring, not so much here in northern Arizona. Anyway, so let's a couple things that I want to get into tonight. Before we get into the commentary, I will make sure that we get the commentary marked so you know when that starts, because I'm going to go through a couple things that I think are going to become very interesting as go forward. And today I had a pretty deep discussion with Dr. Baker and I talking about the banking system, and we always dig really deep, and it triggered me down a couple rabbit trails, which I decided to share with you tonight. And I think these are what I'm going to give to you now is where I think we are, what's going to go on with this. I'm going to do air quotes, so-called banking crisis, which we did see, a multi-century old bank disappear this week. So history definitely was set. But let's just talk about a couple things. And so there's a famous saying, and it's biblical of nature, but it says, "The thing that hath been is that which shall be, and that which is done is that which shall be done. And there is nothing new under the sun." And the reason why I quote that tonight, it just kind of flashed out. Ralph and Elliot quoted the very last part of this, was "there's nothing new under the sun." I'm going to illustrate to you right now that there isn't anything that has happening in the banking system today that hasn't happened multiple times. And I started digging into the history and the events. Now, some of these events that I'm going to talk about were catastrophic in nature. And let's just go through it. And then we're going to start all the way back at 1720. Okay. This is going to take me just a couple minutes. I think you'll see the point here when I get done. So the South Sea bubble, the East India Company went down, took down the markets. Every one of these things I'm going to discuss was the following or during was a financial crisis. And the panic of 1792 was, listen to this. This is so familiar. Just take a listen to this. The Bank of New York invested heavily in government securities and real estate. Sound familiar? This was the panic of 1792. The panic of 1819 was the boom that followed. We're going to go through a boom and bust cycle. I just want to point this out. You'll get the point here in just a minute or two. So we went through these boom and bust cycles. So we had the panic of 1792, I just mentioned, the panic of 1819, and we had a boom after the end of the War of 1812, and then things got way overheated and we crashed again. And then we go to the panic of 1837. I'm not going to go through the details, 1857, and that was the beginning of the railroad boom. And then, of course, we had the Civil War in there. And after the Civil War, there was what? Another boom and then a bust. So this is something that I focused on and I've studied fairly hard. Going back to 2008, everybody was focused on 1929. I was looking solidly at 1873. And this was after the end of the Civil War, as I mentioned, and the rail boom, but there was an investment company. This was as close to Lehman's moment as you could get in history. It was Cook and Company Investment Bank. It failed, took everything down. And not when I say everything down, it took everything down. This was a multi-decade depression specifically in Great Britain. It lasted all the way into the early 1800s. And it was absolutely brutal. It took down everything in sight. And of course, then as we go forward, there was the panic of 1907. And once again, this was Knickerbocker Trust. And guess what it was? A run on the bank. So all the depositors taking their money out. Right after the Knickerbocker Trust went down, guess what happened? They formed the Federal Reserve in 1913. So this brings us into more modern times, and I think this history lesson is going to be interesting when I get to the end. So, and of course, after that, in 1929, did it really do much? I'm not sure. 1929, we all know about the crash of 29. Won't go through the details. You probably should know that. If you don't, you should go study that. But then there was a huge gap in crises. There's no banking crisis. There's nothing in going all the way, even with World War II in there, there was no, the 50s, the 60s, we had to go to the 1980s. And I'm going to come back to this probably, if not tonight, I'll go through this in the next couple times we're together. Tomorrow we'll focus on the Fed. maybe tomorrow night I'll finish this. We'll just see where I go. I'm going to go until the flow of consciousness stops, okay? And so in 1980, 1990, we had the S&L crisis. And that was an interesting time because that came from Volcker raising interest rates again, over speculation in real estate again, okay? And then we get, I think it was around 680 S&Ls failed. And this is what triggered me today when Dr. Baker and I were talking. It just, man, I just couldn't get it out of my head. I spent the whole afternoon looking at this stuff. But they right after the S&L crisis, they formed something called the Resolution Trust. And that was basically a bad bank. It was, they take all the assets from these banks, throw them in there because the FDIC, and there was another entity at the time also that was involved in that. And they weren't in the business of running banks. So Congress set up this thing called the Resolution Trust, which was to deal with these assets and liquidate them. And I think it ran through around 1995. I think it was 1989 when that was set up. And so they had 680 banks, all kinds of crazy assets, mostly real estate. Everything was jacked up in every way you can imagine. And it was interest during that time. It was coming into the 1987 crash. Everything seemed to work pretty good. The 87 crash had nothing to do with any of this stuff, the S&Ls. We just kind of floated through that. And I was primarily a bond trader in those days. And we just kind of floated through all this craziness of the S&Ls, like another one failed, another one failed. It didn't matter. I guess, you just you'd had to been there. But everything kept going. We had the 87 crash. We had a little mini 89 crash. This is when about the time that they formed the Resolution Trust. But this was an interesting situation to deal with the large banking crisis, okay? So, I won't go through all of the scenarios. We know what happened after that. We had several, obviously, .com and the GFC, and people, let's get up to today. So I'll finally get to the point that I wanted to make. And I believe, and I have to quote Dr. Baker again because he sent me an email. He's going to laugh when he hears this. He usually listens to the broadcast in the morning. But he said that Bear Stearns I was giving him an analogy of how I see ripples in the markets caused a ripple, and Lehman caused a tsunami. And that's exactly what happened. So what we just had, I'm finally getting to the point, but I want you to understand what we just had was a ripple. And we're already seeing stabilization. You saw banks jumping 4 and 5 and 7%. Republic Bank up 30% today. So all of this stuff's getting worked out really quickly. Even though we go through Credit Suisse, the biggest rival in the world, I made a note. Credit Suisse was formed in 1856. UBS was founded in 1862. So they have been rivals for hundreds of years, right? And here we are today, and Credit Suisse is gone, and Union Bank is in trouble. I think they should drop the Union, just be Bank of Switzerland. I don't even think they need the Union on there anymore. But all of this, what I'm trying to illustrate to you, is all of these events have happened. We could dig into each one of these crises that happened, the panics, one after another. And if you want to see something that's about to happen, you get this boom-bust cycle. Seems to be maybe playing out a little bit right now, but look at what happened in 2020. And I'd love to go into everything that I went through this afternoon. It would take me hours, and I know maybe you didn't come. You want to hear what I think about the current markets, which I will get to in a minute. But I can tell you there's so many things that came up this afternoon. I had to have some comfort food. I ate a full pint of strawberry ice cream this afternoon. It was kind of funny. I need some comfort food here after all this, because there's a whole lot of things that are happening here. And I've been arguing this since it started, since SBV happened and all some of these other banks. It's just not a big issue here. There's nothing. It's not that there's nothing to see here. There are things to look at. And I made a comment, I think it's on the next page. Oh, yes, it is that the whole idea that because of this and all the rhetoric, and I think maybe Twitter and a whole lot of social media, they've got Treasury. They get, I won't call Janet Yellen names. She deserves to be called names, but I will just call her Janet Yellen tonight. And they're talking about guaranteeing all deposits in banks. What the hell is that? One of the most frustrating things for me has been that people are talking about the uninsured assets in banks. Well, wake up. It was that way last month, 3 months ago, 3 years ago, 10 years ago. There was no one ever saying that every asset that was deposited in every bank is guaranteed. That's not how banks work. All of that scenario I just painted for you, going back to 1720, could not have happened. Banks just do this. They fail. There's over speculation. It's human interaction with the world and money. It's greed and all of that stuff that's happening. And so, I could sit here and after doing this, I could paint a picture of absolute disaster, and maybe it will be. But we have issues in commercial real estate, all kinds of stuff that is got to be worked out there, primarily office buildings. And a lot of these small intermediate banks own that stuff. And it was interesting that today, the big players and BlackRock and others, all these stocks were up 4 and 5% today. All the people that are playing in these big office markets. So it's interesting to see how the interpretation of the market. So I'm going to end this at this point. But most people are probably thinking right now that it's being priced in that the Fed is going to do nothing or drop rates or something like that, drop 50 basis points. All of the big real estate guys need that drop in interest rates, and they're begging for it. They're not going to get it. Okay. My opinion is that the Fed will raise rates by 0.25% tomorrow. They will stick to the basic narrative that they've been putting out to us, and we're just going to continue to go down this path it's just not going to change, folks. And this whole crisis that we've been seeing is pretty much handled right now. And you can see the market's starting to realize that. And I know many of you, and I saw comments on the YouTube channel, and I've been fairly quiet on Twitter because I've been really busy with some other projects the last couple of days. But, I've seen stuff out of Twitter that everybody's like, no, you don't understand this big crisis. It's 2008 all over again. And I've been arguing, you folks have heard it, so I won't bore you anymore with this conversation. But it is not 2008. It is 2023, and it's completely different. And all of these issues are isolated, and there are other issues to deal with. So I'm not saying everything's fine and it's, Goldilocks time. There are a lot of issues in these markets. Debt ceiling, I could go on the national debt, and I could just spend hours doing this, right? But what happens is, my old comment, markets can't chew gum and walk at the same time. They're going to focus on one item at a time. And the biggest item is what they're going to focus on. The shiniest object is what they're going to look at. If you watched, I don't care what channel you watched on any kind of media, everybody's focused on banking crisis, banking crisis, banking crisis. And that's, like I said, again, things that get so negative, it can't be real. I'm looking at the S&P here, trading 40.36. And I bet there's a whole bunch of you listening to this right now that didn't think you'd be seeing that number on your screen. So hopefully you didn't get caught in a squeeze today. There's more to come. But let's go ahead. I'm finally ready. So from this point right here, I just want to see where I'm at on broadcast time. Okay, I'm just going to write this down so my guy who does the videos will be able to fix that. Okay, so let's go ahead and get into normal thoughts on the markets finally here. And I appreciate you folks listening to that rant. I just needed to get that out. This controlled my whole afternoon. And so I needed to get that out. So let's talk a little bit about, something that I've been kind of preaching about for the last 2 months. The retail housing market is bottoming. We saw increase in sales 14.5% this last month. And think about it, they're starting to stabilize. You'll see when I talk about the interest rates here in a few minutes, everything's going right back like it was before. And I'll talk about some of these jolts, these volatility jolts, and probably be able to discuss that even more live tomorrow, because there will be a live cast, and I'm going to start at 1:30 New York time tomorrow. Will be the time where we start the live stream for the Fed. So I'll be on about a half hour before the announcement, and then we'll hang around for up to the close from that point. But the home sales are starting to improve. You're looking at the interesting thing, year over year, though, it was down 22.6%. So it's not good. It's not like there's a boom going on, but they're stabilizing. And this kind of blip off the bottom here is that stabilization. And so we're really not, we're not seeing the collapse anymore. There was a drop in price. I think the first time that median prices downclicked for 11 years. So there's a lot of flattening out. There's a lot of good things. Guess what that all equals? More of the, we'll call it disinflation, right? Where it's starting to slow down. And we're seeing crude oil traded in the 66 handle. It didn't seem logical a few weeks ago. And we're seeing a lot of shifts in configuration that's going on here. So tomorrow's going to be a very interesting day. So I mentioned a little bit about what I think the Fed's going to do, but I think they hold the line on the increases. Think about this. Right after Credit Suisse went, everything's blowing up and all these banks are blowing up, ECB, European Central Bank, comes out, and what do? They raise rates by 50 bips. And why? Because of inflation. And I'm telling you, the central banks are all centralized right now. Just like you saw the dollar swaps come out on Sunday, you saw, everybody in on the group. And I don't think the disruptions that they thought were going to happen in the dollar swaps actually played out very well. So it looks like even with this whole thing that went on with CS, Credit Suisse, and the UBS and Switzerland and Europe in general, all this stuff normalized like within a day. It was amazing. Seeing a little downward pressure, I think, in the Swiss franc, but not for material. And so my point is that all this stuff is really very quickly normalizing. And I made a note here on this Treasury guaranteeing all deposits. I'm going back just for a second. It's like, it doesn't appear the Treasury has a lot of money. I'm not sure how the Treasury is going to do this. FDIC will ultimately end up needing to borrow money if the expansion of their participation in these bad banks, because what's happening with the bad banks, with the banks that are failing the Republic, nobody wants their commercial real estate portfolios. They want the deposits. They want maybe, car loans. They want some other stuff, but they don't want the big stuff. They don't want that material stuff. And I told you I'd return back to this. This is why I was talking about the resolution trust. It's possible if this thing gets really ugly, they're going to have to develop some unit, because the FDIC, right now there's basically an FDIC bank that's forming. And these guys do not have the facility or the wherewithal to manage all these assets. So it's potentially, depending on how this all plays out, that there might be a little resolution trust in our future, something like that. It just popped up for me today, and I just couldn't get it out of my head. And sometimes that seems like a logical place for everything to go, just to get these assets off of the books and have some control and have some ability to liquidate. Because think about this, there's more to come on the commercial real estate, especially on the office building side. So there's going to be more of these things. We've seen, a bunch of the big players, the Carlyles and other folks, they've walked away from a lot of fairly big deals. They just like, hey, we can't, there's no rent. We've got expenses. We can't afford to float this thing. Let's just walk away. It's cheaper to walk away, and it's small little pieces of their larger portfolio. But in the end, somebody's got to be the bag man. and nobody wants to be the bag man. So ultimately, maybe what I'm talking about here is that they end up setting up a designated bag man for all of this stuff, because there's trillions of dollars of this office space, and we'll see what happens with society and whether people go back to office buildings, what happens with commuting, all that stuff. We've got a long ways to go after the disruption of COVID and everything that happened when they shut the country down and changed basically all the work habits. Just looking at my notes, I think I'm finally done. I had 4 pages of notes tonight, folks. So thanks for your patience. And I will, I think there's more to come out on this. I'm going to be watching this scenario that I painted tonight very closely. But I think it's worth, hopefully you found it worth going through some of the history to tie together really where we are and what's going on right now, and that it's nothing new. Remember, there's no new thing under the sun. So let's go ahead and let's get into the database and get through the rest of the night. We've got a fair amount of technical stuff to cover as well. I did warn you guys, it is a popcorn night, so you might want to start another batch. So as we look at the database, we did have 1,042 buy signals, 132 sells. We're up to 17.03. $17.03 bullish, so we're a long ways from that 22 marker and then to 28. But this is at least encouraging. Had a fairly big day. S&P up 1.3, NASDAQ up 1.58, and Russell up 1.88. So we had a decent day, bounce off the lows, whatever you want to call it. But there's still a lot of work to be done structurally. And I talked about this last night. I talked about how long it's going to take to make this rotation to get traction back in the database that's material enough that the markets can drive higher. But even with a very narrow database, I mean, I'll go through here in the technicals in a minute. We're back up toward that 40-50 resistance. There's some interesting things going on here. So, but the overall database on a short-term basis, we have 0 sectors long. We have right now 11 groups out of 102 industry groups. And so there's an individual indice that we build internally for each one of these. And there's only 2,685 stocks long versus 13,082 stocks in a neutral position. So there's a lot of rebuilding to do on the database on a short-term level. The longer-term intermediate database is still long by about 58% or 53%. And so that we won't get an update on that until Friday night. I'll talk about that on Sunday. But it takes a while once you get this database to crush down like this, like we've seen. And once again, we not only tested 39.50, we went to 38.50, and now here we are, where over 4,000 again. This is actually one of the better closes we had today that we've seen for a while. So let's go ahead and get through the rest of the technicals. Let's get into the S&P. All right, so the S&P is, this is an hourly chart, continuing on the uptrend a bit here. We're looking at last print, 40.3750. We've kind of topped out in here. Those of you that know of this, and I talk about it on this channel, but you've been in the live room, this is a bit of a dragon head setting up. So it typically will set up and resolve itself to the upside. There's no current Fibonacci targets other than there is a Fibonacci target at 40.15. So we could see a little retracement. We'll go through the market grid here for the dailies here in a minute. But the algos are suggesting that we're we're going to see some declines. And as usual, we're going to possibly decline into the London Open. You can see the downslope here on the indicator. ppm 1, ppm 2, and 3 are all kind of peaking out here. So there's at least 2 or 3 hours. That's up to about 4.5 hours of potential downside. And but we should hold probably above 4,000. And like I mentioned last night, let's go over to the daily here. And daily is flat today, but looks like we're going to see some pretty good upticks here. I talked about some of these numbers last night. Didn't think they'd be hit, but 40.57 is fib target 2. It's the green dots where I've got my cursor at right now. That basically hasn't been quite satisfied, but I think that gets hit. And then ultimately, fib target 3 is at 40.94. Those are going to be key areas on the daily chart. We're looking at the, let's go over and take a quick look at the market grid here on the ES. And we'll take a look at this and we'll see what, let me get the sheet up here. What we're looking at is right now the S1 level 40.17. That's probably we printed down to a low of 40.32, so you could see some maybe early. This is where we trade overnight, trade down into that level. S2 39.37, and then R1 54, which plays into those Fibonacci ranges. So R1 54, R2 74. I think there's a possibility of probably getting an expanded range because we have the Fed coming out tomorrow. S2, R2, which is 39.97, 40.74. And I won't make any predictions about which way other than let's go back to the algos and we'll discuss what that looks like right now. As the algos, like I said, are suggesting we're going to see a continued uptrend, that the 10-period moving average is going to turn up. We should see the 10 cross over the 21. That right now is 39.58. It's not really advancing by much. It's just starting to turn up. But that crossover, the 21 will be positive. So we're going to have some pretty decent resistant support at around the 4,000 level. And all the algos are suggesting an upward bias. So what's likely to happen, let me draw this in so you have a good understanding of this. What's likely to happen here is that the 10-period moving average is just, all of these averages are going to start to roll up here. As long as we stay above these values, which the low end value is 39.79, we stay above those averages on a closing basis, we should ultimately, I'm drawing in the 40 period. What should happen is we start to see the market do this, and then from the market itself should start to try to move up into this pattern here, and the market grid should turn up as well. It looks like this acceleration here on the PPMs is going to be enough, at least pushing up toward that upper end above that fib targets I just mentioned. That 40.94 is going to be right at, we'll call it 4,100. It's going to be a pretty key number. And I won't go through them tonight. We'll talk maybe tomorrow. We'll have lots of time to hang out together as well. So we'll take a look at that stuff tomorrow and just break it down a little bit further. But that looks like how it's set up for the S&P for tomorrow. Okay, so here we are looking at the NASDAQ. NASDAQ had a great day. We got up to this fib target 3, which 12,864 seemed almost silly to mention last night. This is a pivot level. So if we closed yesterday at 12,867, so we traded just above this level. If we can maintain above this pivot, I suspect if we can close higher tomorrow or on Wednesday, that we'll see the market grid turn up and there's more upside here. The PPMs on PPM 1 is at a positive 0.52. A 0.25 is the trend mode. So we got double the trend mode. But if you look at the slope of the 21, all of these averages are starting to turn up. And I mentioned this several days ago. I recall that I was talking about the NASDAQ is going to lead the way here for the next several days yet. Okay, so let's go ahead and move on to the Russell. So here's what I was talking about yesterday, where we're going to trade. The indicators were suggesting we're going to get above the 10-period moving average. Now we're definitely looking at a confirmation, probably maybe tomorrow, but most importantly on Thursday and Friday. It looks like we could get some acceleration back towards the 200 and the 21-day moving average. We should come up in this pattern just a bit more in here. The key levels to watch: the 10-period moving average is still negative, but let me draw this in because these patterns are important to understand. Let me draw in what's likely to happen here is this 10-period moving average is going to start to roll up. This average comes down. This one comes down a little slower. And ultimately, we get these patterns to start to all turn up. And then the last one is over here where things start to turn up. And if that happens, then we get into retesting some of these areas over here on this chart. So, and this is true, this has a bit different configuration than there is on the NASDAQ and the S&P, but this is definitely, there's similar points on those charts to watch for. And hopefully I'll be able to answer some questions tomorrow. Be able to dig in deeper on that because I'll have more time to interact with you folks as well. All right, next we'll take a look at the 10-year. So very interesting. I talked to you yesterday. I thought we had bottomed. The grid did turn up, and we're looking here at coming right into this 10-period moving average. And right now, the 10-period moving average is dropping substantially. So there should be some resistance right here at the 396 level. And I think it will hold there. And there's one other thing that I'm going to keep using my drawing pin here for just a minute because I want to make sure that we're all looking at the same spot here. So here's the 10 market prices are coming in right here at this level. And what should start to happen, there's a value right here. This is a pivot area at 365.90. So if we get above that level, that's going to be key. And I think I misquoted, I don't know what I said, but 363 is the 10. It's right at that pivot. I don't think we get over that today. With Powell speaking and all the Fed actions, we could see it. But if you look at the algos over here, this is suggesting that we're going to ultimately right here, about 2 sessions out, we're going to cross the second derivative. If this is accurate, and that means we will cross that 10-period moving average at 363. This pivot area will also get crossed, and that suggests that we end up going toward the 21, which is all the way up at the 380 level. So that will be a big sign for everything kind of coming back into the pattern here. Let's take a look real quick at let's look at the 2-year from a yield standpoint. And this is a similar chart. We're sitting here right on the 10, but we're looking at 1-2 sessions out. We should start to move up. There's a pivot up here at 430. What's likely to happen is we're going to move right back toward 440, 450, maybe 460 on the yield, and we're going to recover a lot of this drop that happened during all of the craziness in the banks. So this was, I guess, an opportunity. If you were a bank and in your trading account, you could have traded out of some of those securities. Who knows? Maybe they did. Maybe they even hedged some of them. It would have been fairly easy. But the point is, these charts are setting up here, starting to look like we're going to get a bit of a turn. There's probably 2 more sessions max. We get above the 10, and we should head back around to the 378, 382 range. Just putting a bracket on that. Okay, looking at crude oil here, crude is continuing. The algos are suggesting we're going to see a penetration in the next 2 days of the 10-period moving average, 70.80. That number is coming down right now, about 70 cents per day. So that'll be right where we're trading right now tomorrow. And we should get through that and head back toward the 21. 74s to 76 should be next target range. This is one of these bubble bottoms, and I talked a bit about it last night, but all the algos are suggesting at least some improvement, or some, in the case of PPM 2 and 3, what it's telling us is that the downward pressure of these trends are going to dissipate a little bit, which opens it up to at least testing these values or potentially getting above them. In the next couple sessions, we'll know. But for right now, the PPM 1 is suggesting we will get through the 10 value, and we'll probably trade in between that toward that 21. But remember, the 21 is declining every day as well. This is the daily chart. So that number is dropping about 30 cents per day. So all of a sudden we're going to be at 390 or so. And so that's why I'm putting that bracket range up there around 72, 74 into that range. So gold got hit pretty good. Why? Interest rates went up. I told you we probably trade within the range. We're going to see a correction back in here on gold. We got up round to the numbers I was talking about last night. STX yesterday was actually at, see what the number was here. STX was 1935. And the low print was 42.80. So we got almost down to it. We're seeing some stability. I was talking about this 10-period moving average coming into play very quickly. That's what's happening. 1922, it's going up. It will be around 1938 tomorrow, and we're trading 48. So we're going to have support right underneath this market here as we come into that day. But I mentioned this last night. If we look at the algos, let me draw this in a bit so we make sure you're focused in the right place here. So if we look at the algos are on the PPM 1 is declining. It looks like we're still going to stay in trend mode, but this level here, it looks like we're trying to round off. Meanwhile, the 21 is starting to accelerate. The big support is going to be this 21-period moving average. And as I mentioned the other night, we got this RTX sell here. So just 1 to 2 days sideways. We got 2 out of this already. We'll probably come back into this range. Since we've got what I call the box formation here, where the market grid kind of goes square like this, typically what we do is we end up doing some kind of consolidation in this range here. And as long as PPM2 stays in a positive mode, looks like in the next several days before we even think about breaking the second derivative here. But we should see consolidation. Don't see a complete failure in this pattern, but if one of the things that I was just talking about, if I go through that scenario, really what we're looking at here is that if, let's say, the 2-year comes back into 450, 460, all these rates kind of bounce back into the range where they were prior to the shock that hit, then gold is going to have a bit of trouble going through the print up at 2,000. I'm sure guys like Peter Schiff and whoever the gold bugs are were screaming at 2,000. It's going to the moon. But the reality is what we painted up here right now is probably the most likely scenario. There's some other things I'll wait probably until the end of the week or Sunday night to go through the weekly or the intermediate concepts here from the standpoint of what's likely to happen. So last we'll cover Bitcoin. And the patterns that we're seeing here, I mentioned last night, we're just kind of consolidating up here. PPMs are starting to crank off a little bit. Just like with gold, you want to watch this 10-period moving average. That is right now 26,504. We should see that coming up. See how much it's moving. It's moving roughly 600 per day. So we're looking at 27.1, 27.7. Last trade right now, 28.772. So within the next 2 sessions is potential test of the 10-period moving average. And if you look at the algo is saying that we're going to probably penetrate through the 10. So that value is going to be key. Once that happens, then you'll probably come into this lower values. I would argue that the Bitcoin and gold chart look very, very similar in the way that it's shaped right now. So I would definitely be looking at watching this pattern very closely, but it's simple. The 10 should hold it, and I don't see that, like I said, that this thing's probably going to stall in here somewhere. I talked about this a couple of nights ago, and we're just seeing this crazy, we're over the 200-week moving average. Let me bring this in just a little bit so you get a better perspective. We're above the 200. It looks to me, even here on PPM 1 on the weekly, that's going to be your key support 23.4. And just to get you a value here, we're looking at about 700 per week. It's very similar to the daily bounce, but the daily number is coming up very quick and is going to be in play in the next 2 sessions. Okay, folks, it's just a final comments here, and just see what you guys are talking about. I have talked a little bit about gold. I saw some comments about 3,000 gold. There's some upward targets in the mid 2,700. Anything's possible, but at the moment, it's interesting. I just want to just at the end here. So if you've stayed this long, thank you for hanging out. But one of the things that is interesting in the discussion that I had earlier today is when these I call them shock waves. I'm going to give you an analogy. You look at a perfectly crystal clear pond, and there's not any movement in the pond. So when something like SPF happens, there I did it again, SPV, something like that happens, and it throws a shock wave. It's like throwing a giant boulder into the middle of the pond, and there's just ripples come across the lake, and it takes about 5 to 7 days, maybe as many as 10 periods of time to normalize. So if you go back, think about this back to 2020, and you can't see the chart, but I'll bring it up here real quick just to get a handle on this. But if we go back, it was, if you go to the 2020 crisis, and I'm just counting here, it was about 7 or 8 months after that crisis, and when we came into November of 2020, if you took out that other piece and you slid the chart over, what you'd see is that it's like nothing ever happened, that the whole collapse in 2020 didn't happen. And you could argue that the fact that that was a very unique situation, that was the big rock in the pond, that all of a sudden it stabilized, and then we ended up in this monster trend, going all the way up to, the 4,500 handle. And it's, when you think about that wave that hit it, this was just one of these little ripples that came across. It felt like a tsunami. It felt like it was going to be really big and everything was going to roll over. And the S&P, and even in the early stages, I thought we were going to get a big rollover and was talking about some crazy downside numbers. But all of a sudden, the thing that saved me was our short-term database. Literally on March 23rd, bought over 3,000 symbols on that day, and then it just started buying with both hands. And by the time we got to July, where we were then, and then we even got more buys, and it just kind of rotated in. And then in October, November of 2020, we had our intermediate models just buying everything it could find. And that was a set for 2021 and maybe into a little bit of 22. The reason why I mention that is these ripples that happen, we'll see them tomorrow. Chances are when we get the Fed announcement, whatever that is, we'll get that volatility, and you'll see how, and hopefully if you're on there, remind me to talk about how that normalization of volatility, usually it's pretty normal that I will talk about those things as we get into that range. But that tomorrow should be reasonably exciting. I know every Fed meeting is put out there as it's the most important Fed meeting that there's ever going to be. This one's pretty significant. I think that the Fed I think they were ahead of some things. I think setting up the dollar swaps on Sunday relieved a lot of folks after the CS deal with UBS. After that happened, I think that kind of normalized everything to the point everybody's like, okay, they're involved and they're maybe trying to get ahead of some things. And I think they did get ahead. I think they headed off what could have been, some really shortages of dollars and people scrambling. If that would have been seen in the marketplace, in market action, in pricing and spreads and what have you, that would have been all it would have taken to really roll this thing, and they would have had a big thing to handle. This week would have went much different than it has already. But the point of that is that they did do it and they are ahead of things. So it looks to me that markets are fairly stable. We'll see what they say tomorrow. Look forward to hanging out with you folks. So remember, it'll be 1:30 tomorrow. Fed's release comes out at 2, so I'll be live a half hour before the release tomorrow. So as always, thank you so much for coming around and hanging out with me tonight. And hopefully you'll be there tomorrow. Tell your friends. We'll hang out, and hopefully we'll get a chance to answer a lot of questions. So have a great night, everybody. See you mid-session tomorrow. Have a good day trading. Talk to you later. Thanks for showing up. Appreciate it. Hit the like button and subscribe before you leave. See ya.